Morningstar, I'm Christian Charret. Mutual funds and exchange-traded funds have a lot in common, but one thing mutual fund investors typically don't have to bother with is liquidity. With me today to explain why liquidity is important to ETF investors is Mark Noble, Senior VP and Head of Sales Strategy at Horizons ETFs. Mark, thank you very much for being here today.
Great to be here, Christian.
So to start off, for viewers who aren't too familiar with the concept, can you explain to us why liquidity is important to an ETF investor?
Well, it's important to an ETF investor because it's a built-in cost of investing. So when I'm a mutual fund investor, liquidity is something that's already dealt with the price I pay for the mutual fund unit. So I call up my broker or I go on my discount brokerage and I buy the mutual fund. That cost is built into the cost I pay for the mutual fund. I don't see it. When you're talking about ETFs, there's actual real cost that's right in front of you with buying an ETF. And the liquidity manifests itself in what we call the bid-ask spread. That's the difference that someone's willing to buy and sell the ETF in the market. And the wider the spread is usually an indication of the liquidity of that ETF, because ETFs, similar to mutual funds, are open-ended investment trusts, which means that they need to always be able to create new units. And in order to do that, they also have to have a value that's reflective of the underlying value of the securities, which is called the net asset value. And cumulatively, in order for market makers, which are the institutional capital markets groups that create new units, in order for them to be able to create new units, they need to be able to go to the market and actually buy the underlying securities that underpin the ETF. So there is a cost to that, and that cost is reflective, again, in that bid-ask spread.
So how can an investor gauge the liquidity of an ETF? What would be the standard numbers that they should look for?
Well, it depends on the underlying structure of the ETF, but generally speaking, most ETFs in Canada have posted on their website something what we call the net asset value. On the previous day, you can usually see what the net asset value is, which is the cumulative value of the securities on the website. Now, of course, as market movements occur and that NAV changes, the market price can also change. But you need to understand that that's sort of the anchor that you want to look at. Then the other thing you want to look at, particularly if you're using a discount brokerage account, is the difference between what you would pay and what you would sell for the ETF. That spread, which I've talked about as a bid-ask spread, is basically your cost of acquisition for the ETF. The market makers tend to make the same sort of commission, usually about half a penny to a penny, regardless of the ETF. So the wider the spread is usually an indication of how liquid the ETF is.
And do most ETFs in Canada have good liquidity?
They have excellent liquidity. In fact, liquidity is probably one of the first things that an ETF provider looks at before they launch an ETF. They want to make sure, because they are an open-ended investment trust, they want to make sure that you can buy and sell these very easily intraday on the market. Of course, certain asset classes, particularly as you get more into nichier fixed income classes like high yield bonds, preferred shares, they are a little bit less liquid in Canada. You know, the preferred share market, for example, is only about $60 billion. Therefore, you're going to have slightly higher spreads on those products. On average, though, the average bid-ask spread in Canada tends to be about 20 basis points, which versus as a cost, that is the cost of the bid-ask spread versus the actual market price of the ETF. Outside of that range, as you start to get to 25, 30 basis points or 40 basis points, that's where it starts to get a little bit higher, and you may want to take a look and see if maybe it's trading a bit wide.
And what can an investor do if they want to buy an ETF that operates in a thinly traded area?
Well, first understand, is it a thinly traded area? And look at what the cost of not just one ETF, but multiple ETFs are. So if you buy, you're looking at an ETF and it's trading, 7 or 8 cents wide or 40 basis points wide, however you want to look at that metric, and that raises your eyebrow, look and see if other ETFs that also invest in that asset class, preferred shares is another example I'll use, see if they trade similarly. If it seems really out of whack with other ETFs that trade in the same asset class, that's where I would actually say you may want to give a call to the ETF provider and see if there's something actually happening there.
And there are trading strategies that investors can use as well.
There are. I have 4 that I say all ETF investors should really be aware of. Number 1, don't trade at the start and end of the day. So the 15 minutes of the start and end of the day, try to avoid trading in those periods of the day. And the reason I say that is because all these market makers who make this important ecosystem for the ETF world, they are actually rebalancing their own exposure. So there can be price dislocation. So if you're a longer term investor, the volatility of ETF pricing does tend to increase at the first 15 minutes and last 15 minutes. If you don't need to be trading at that part of the day, try to avoid that. The second most important tip is always use a limit order. Use a limit order not only on buying, but also on selling. make sure that the price that you want to pay is the price you try to execute at. Now you need to understand that the price may move away from what your limit order price was, but it's an extremely important way for you to protect yourself from getting a price execution that's way off and way more expensive than what you would have thought it would have been. Number 3, make sure that you're trading when the underlying market is open. So commodities tend to close up early in the afternoon. Of course, if you're trading foreign equities, something like Asian equities, ETFs, that would trade 12 hours away, so it's closed the whole time our North American market is open. Because ETFs are an open-ended pricing mechanism, they have to be reflective of what the market value is. And we don't really know what the market value is if the underlying market is closed. So your price execution is going to be a little bit different from the intrinsic value when those markets are closed. And number 4, as I highlighted earlier, when in doubt, call the ETF provider. We have a obligation to want to make sure that our clients have as seamless an experience as possible when they purchase an ETF. And we have customer service representatives, not only at our firm, Horizons, but across the ETF industry, all the other providers, to make sure that your execution happens as seamless as possible. So if you think something seems wrong, it never hurts to pick up the phone and call the customer service representative.
A lot of useful information. Mark, thank you very much for sharing it all with us
Always
today.
my pleasure.
And for Morningstar, I'm Christian Charest. Thanks for watching.